Thank you, Mr. Chairman. Chair Yellen, good to see you. Thank you. The latest stress test scenario that was published by the Fed includes this scenario where the rate on 3-month U.S. Treasuries drops below zero from the second quarter of 2016 through 2019. And I recognize that this in no way predicts any future action here. As a matter of fact, CCAR announced specifically in the document there that this scenario does not represent a forecast of the Federal Reserve. Nonetheless, this timing is interesting because it comes at a time when the European Central Bank and the Bank of Japan have both instituted these negative interest rate policies. So the question I was going to ask you, and let me make one other point. It may suggest that the Federal Reserve is not opposed to reducing its target rate below zero should economic conditions warrant, and may be employing the stress test process as a tool to consider its possible impacts. That strikes me as maybe the reason you deployed it in the scenario. You told the committee in November that if the economy were to deteriorate in a significant way, potentially anything including negative interest rates would be on the table. And so, and I remember those remarks were echoed in January by New York Fed President Bill Dudley. So, assuming for a minute that the Fed figures out this question about the legal authority, do you still believe that negative rates are a tool in the toolbox? And can we assume that the Federal Reserve would not include this scenario in a stress test if, in fact, it were not a potential future action?
Well, let me say that that was not what motivated the inclusion of this scenario in the stress test. We are in an environment where, as you pointed out, a number of the ECB, other European central banks, the Bank of Japan, have gone to negative rates. Through much of Europe, interest rates and in Japan are negative way out the yield curve. And we have had periods of market stress where we see a flight into U.S. Treasuries as a safe haven, and the scenario that we ask banks to look at is one in which Treasury bill yields go yet negative. This is something that could potentially happen without the Fed actually setting negative interest rates. It is something that could happen, and we've seen it happen for limited periods of time in stressful situations.
Well, let me ask a clarifying point, because it has been kicked around since 2010, the possibility of the Fed maybe setting negative interest rates,
I mean,
right?
So
I just quick question on looking at the Fed authority. You haven't taken a serious look at the Fed authority until now, while it was kicked around then, and you do the scenario in the interim.
So back in 2010, when we were looking for ways to consider to add accommodation, to have a toolkit available, it is something we looked at. We got only to the point of thinking that it wasn't a preferred tool. We were concerned about the impacts it would have on money markets. We were worried that it wouldn't work in our institutional environment, and we thought that zero was really the effective, or very, very little was.
Let me ask you then, really quickly.
In the spirit of prudent planning, it is something that, in light of European experience, we should look at, not because we think there's any reason to use it, but to know what could potentially be available. And it isn't just a question of legal authority. It's also a question of, could the plumbing of the payment system in the United States handle it? Is our institutional structure of our money markets compatible with it? We've not determined that.
Okay, well, let me just say that I think that the central banks in Japan and Europe are trying to overcompensate for irresponsible fiscal policy. I think that's what put them in this position. Can we avoid the same mistake here in the U.S. If we get our fiscal house in order? In other words, do you agree that if we address the long-term structural problems with soaring mandatory spending, we would decrease the potential need for monetary policy actions that reverse course on interest rates?
I think it is certainly desirable and important for the long-run stability and growth of this country to take the measures that you've suggested. And evaluating the stance of fiscal policy, it is something that affects our monetary policy
Thank you,
options.
Chair Yellen. Thank you very much. Thank you, Mr.
Time of the gentleman has expired. The chair